So today as we mentioned, we are continuing on the June 2023 question number 3. June 2023 question number 3, the case study question. I'm sure like you would have watched the preceding discussion of mine, which was done some time back. So straight away going into the questions on the question number 3. Right. So I believe that you all are having the question and the suggested answer both, because we will be taking through that, and then any of the concerns and things which need clarification, we will basically discuss. So the question number 3, first part, A part of the question, request the request the comment on question, request you to comment on whether the offer price of 175 million for the 100% equity shares of CSL seems attractive. We know that CSL is a hotel company and it was not performing well. The preceding discussion would have covered it. So the company is now trying to look at the disposing the hotel company, and there is an offer price of 175 million for the 100% equity shares of CSL was offered. So the question asks us, comment whether the offer price seems attractive. And within bracket, they have said the corporate finance team's projection is unbiased with probability of 75%, and only a 25 probability can be placed on such projections. So generally, I'm sure like financial management, any area question you look at, when there is a probability information given, what basically we look for? The probability is given, immediately our mind needs to work out what, anyone? Yeah, very good. Expected value concept. So when we see this probability information, we know definitely we need to calculate the expected value of the information given. So they want us to value the company. Actually, the Crystal Sands Beach Hotel company, we need to be valuing. So if you read the paragraph, the additional information on question number 3, actually the Ajit commented on the poor performance CSL, and he continued to question Sajid on whether the 28% return on investment can be derived after an adequate analysis. Sajid was positive and presented the market research work carried out by him, given below. So he has given, Sajid has given the information. Ajit was not convinced and requested independent opinion. Then the corporate finance team has worked out some numbers and they are given you. So there are two table information. One is projection by Sajid, other one is projection by the corporate finance team. So what information? So there is offer 175 million offer given. So we need to value the company. So it's about a valuation chapter. So the information for us to value is given where they say earning before interest tax, year 1 to 3. There are two projections given. One is by Sajid, other one is by the corporate finance team. So earning before interest and tax, year 1 to 3, 125 million. Then free cash flows. Even though earning before interest tax is not a cash flow, the question basically gives us the cash flows. That's the free cash flows before tax, 1 to 3, 80% of EBIT. And the free cash flow before tax, year 4 onwards. First 3 years information, 80% of the earning before interest tax. For year 4 onwards, that will grow by 5%. Then the risk-free rate, next 3 years given 27%. Then year 4 onwards, 15%. Borrowing cost, 32%. Borrowing cost year 4 onwards, 18%. Market risk premium, 4%. So when you see the risk-free rate, market risk premium, that kind of information, what we are supposed to calculate? Any idea? When you are given risk-free, yeah, exactly. Very good. So CAPM based cost of equity needs to be calculated. CAPM based cost of equity or the expected return. Actually, the both terminology is same. Expected return from the investor, cost of equity from the company point of view. We can calculate. So basically, the information is given for us to calculate the cost of equity. So we are aware about it. And the borrowing cost is all given. Only thing is this to make the question a little more complex. The information is given for 2 time periods. One is year 1 to 3, and other one is year 4 onwards. And free cash flow. So basically, the valuation, the CSL company, we are going to value using what method of valuation? Anyone? Based on the table or information given, what method of valuation we could calculate exactly. Free cash flow method of valuation, we can use it because they have given not very detailed information, but they are given very summary form information. But we should know the information, even though available, they have said projection by Sajid and projection by corporate finance team. And the question says, assume that corporate finance team projection is unbiased with probability of 75%, 25% probability can be placed on Sajid's projection. So we need to calculate the value of the company using Sajid's projection as well as the corporate finance projection. Then we have to take 75% and 25% probability, which is the expected value concept. So in order to calculate the free cash flows based valuation, we should know the free cash flows year 1 to 3 and year 4 onwards. Very straightforward. We don't really get into the revenue cash flow, expense cash flow, then you deduct the capital expenditure, working capital. Those all information is not relevant. Very straightforward. They are given a free cash flow. But only complication here, the cost of capital. The cost of capital is not the one cost of capital for the entire projection cash flows. The cost of capital is given in 2 time period. One is year 1 to 3, other one is year 4 onwards. And then we know, I think with your past experience of the past papers, cash flows based valuation questions, you all know that free cash flow based valuation, we are going to look at what free cash flows. Because there are 2 types of free cash flow we are aware. What are 2 cash flows type? Free cash flows point of view? Can anyone share? Exactly. Very good. Free cash flow firm, free cash flow equity. So there are 2 types of free cash flow we all know. So here we are talking about free cash flows before tax, right? So we should know that it's based on EBIT 80%. So we assume that the free cash flow given is before tax is before the interest also, because the 80% the EBIT only we are calculating. Definitely the free cash flow is before the interest cost also. That means the free cash flows to firm is the basis of valuation. I'm sure, like by your theory knowledge or maybe the past paper what you have gone through in the past, you would have known that free cash flow based valuation, the examiner 99% takes on the free cash flows to the firm, not the equity. So we calculate the free cash to firm cash flow based valuation. Then we value the company and deduct the debt value. Okay, so that's basically the idea. So when I take your suggested answer, actually the suggested answer actually takes the net asset based valuation also, right? Even though the examiner doesn't talk about the valuation based on net asset, but the examiner suggested answer uses because free cash flow information is given and net asset based of information anyway available in the pre-seen level. So we can calculate the net asset based valuation also. So it may or may not be relevant, to be honest, but the information is available, so we can calculate the net asset based valuation. It's the easiest method of valuation. So you can see the working number one, net asset based valuation. So you can look at your pre-seen material. Your total assets is 512 million and total liability is 283 million. So net assets is 229 million. So very straightforward. It doesn't take time also. 229 million is your net assets based valuation. So keep that value is on the net asset basis. Now we go to the free cash flow based valuation. So when you go to the suggested answer, free cash flow based valuation, when you're going to calculate, you may take the page number what you call 13. you can look at free cash flows before tax. Can everyone look at the free cash flow before tax? The page number 13, 23, 24, 24, 25, 25, 26. That's the first year, second year, third year, then the fourth year onwards. Free cash flows before tax, as question mentioned, Sajid projections 80%, 80 percentage of your EBIT. EBIT is first 1 to 3 years, 125 million. 80 percentage of that, it is 100 million. So free cash flow before tax is 100 million, year 1 to 3. Income tax expense, working number 7. You can look at the working number 7, which is basically EBIT is 125 million as the information given for Sajid, and 30% taxation, that is 37.5. So please understand, you are calculating tax on EBIT and you deduct it from your free cash flow before tax. I don't think anyone can have any problem here because it's straightforward. Your cash flow before tax minus your income tax, which gives you 62.5 million for year 1 to 3. Then year 4 onwards, they say there's a 5% growth. So free cash flow will grow by 5%, which is another 5 million. Again, taxation, you can look at working number 7. EBIT is another 31.25. That is because of 5% growth. And the tax is 39.38. So you get 65.62 million is your free cash flows after tax. Here there are no other adjustments which are generally given for what you call free cash flow based valuation, which is capital expenditure, working capital investments. They are not talking about it, so we don't have those information and we don't have to worry about it. So terminal value calculation. Terminal value calculation, you can look at it. Here, working number 8, they say 5% growth is there year 4 onwards, and WSC will come to that calculation anyway. Then cash flows year 4, which is basically 65.62. Terminal value is 546. That is a dividend growth model, DO1 plus G, R minus G. So the R is actually your WACC because it's a free cash flow for firm cash flows. Now we go to the WACC computation. In order to calculate WACC, we all know that we should calculate two cost of capital. What are two cost of capital? Anyone? In order to calculate WACC, you have to calculate two cost of capital. What are two cost of capital? Exactly. Cost of debt, cost of equity. Cost of debt, cost of equity. So when you go to look at the cost of debt and cost of equity, we first look at the cost of equity. Cost of equity. So cost of equity, you can see the working number 4. Can everyone look at working number 4 in your suggested answer? Cost of equity calculation. Now beginning of the discussion we said, since the CAPM related information is given, we need to calculate cost of equity using CAPM model. So in order to calculate CAPM model based cost of equity, first 3 years and after 3 years, because the cost of equity needs risk-free rate. Risk-free had been changing from year 1 to 3 to year 4 onwards. Because you know that in Sri Lanka last year to that, I would say this year off, we had a very high risk-free rates information. But we all know that there's a rates available during that period, which is not a kind of a rate for long period. It's only for short period because of the country's economic situation are bad. So there was a doubtful on the debt restructuring also. Therefore, the risk-free rates are very high. So therefore, the question also actually consider that impact. That means otherwise we would have calculated one cost of capital, cost of equity, and calculate WACC and discount it. But we have to understand that since the risk-free rates what was given in the question basically is for only 3 years. After that, they are saying that riskiness will come down. So they are saying the risk-free rate will be 15%. So based on that, first 3 years, we calculate cost of equity based on the CAPM model, 27% risk-free rate, and risk-free in the cost of debt. Cost of debt is also given in the projection by Sajid. Borrowing cost for first 3 years, 32%. First 3 years, 32%. Since it's a cost of debt before tax, we have to calculate after tax, which is after 30% discount. Or discounting means you have to take 1 minus taxation. 32, 1 minus tax is 22.4. Then you know that capital structure you have to understand. Then you apply your WACC computation. So you could see that equity component 229 million. That is exactly your equity value in your balance sheet as per the pre-seen material. Debt is 149 million. Actually speaking, 149 million is excluding the overdraft. Excluding the overdraft. There may be a uh, concern. Some people must be taking the overdraft part of your debt capital. Don't worry, because if you have considered that overdraft part of your debt capital, then you would have made the assumption that your overdraft is also important for your company running. Then you are assuming that overdraft is your part of your debt, long-term debt, that is permanent debt. In that case, your debt amount will change. But if you are assuming that your overdraft is not required for your debt component, in the sense like you don't depend on your overdraft for your running operation day to day, then you are take the interest bearing borrowing short and long term, which is another 49 million. And we know that when we are calculating WACC, there are two things to be remembered. What are two things? Can anyone say that? Exactly. One is your market value needs to be calculated for your equity and debt. Second one, exactly. Second one is your cost of debt has to be after tax. Cost of debt has to be after tax. So these are two things to be remembered whenever we calculate WACC. Here, have we got market value of equity and debt? Have we got equity market value or debt market value? Anyone? Anyone thinks that we have been given the equity and market value and debt market value? CSL is a not a listed company, so you don't have market value for CSL, and it's not given anywhere the CSL market value. And debt, they don't mention it's interest bearing borrowing, so it's typically a bank loan. So we don't have market value for that. So on that assumption, based on information, book value is the market value. There is no other market value information given. So please understand that you don't have market value. So the WC computation, your capital structure, we take the book value. If you want, you can make an assumption to say book value equals to market value. You are considered. Then cost of debt, it's after tax. That's why we said 32% cost of debt for first 3 years. We take 1 minus tax, that is 30% deducted, that is 22.4. On that basis, our WC computation is 27.89%, which is almost 28%. So we can round off and we say 28% for first 3 years. Same calculation, we have to do it for the balance after 3 years, that is fourth year onwards. According to question, your cost of equity calculation based on the risk-free rate, it's not 27, first 3 years 27, after 3 years 15%. But beta, we assume the same beta will be remaining on that basis. And their question itself mentioned, assume that current capital structure is maintained throughout the lifetime. So you don't have to worry about the capital structure is assumed to be the same capital structure. So we take the same book value what you took for the first 3 years, 229 million and another 49 million. And your cost of equity is 19.4. Cost of debt is again the borrowing cost after third year, it's 18%. So we take the after tax as 12.6. On the same calculation basis, our WAC will be 16.74, which is 17%. So these two, if the question didn't talk about your first 3 years and after 3 year cost of equity or the risk-free rate or cost of debt, we would have taken one calculation for WACC and we would have used the WACC for discounting the 1 year, 1 to infinite period cash flow. But the cost of capital information, they have broken into two, first 3 years and after 3 years. On that basis, our WACC is 16.74 for the second period. First period, it is WACC was 28%. So this is basically one projection information. One projection information. On that basis, we have to now use the discounting or the WACC to discount your cash flows. So you can see that projections of initial projection of Sajid, We discount at 28% for the first 3 years. After 3 years, we discount, that's a terminal value calculation, at 17%. Accordingly, you can look at your numbers. We don't waste time there, but please make sure that you understand what I'm talking. So you are discounting at two discounting rate. First 3 years at 28%. After 3 years, you are discounting at 17%. But there is a growth also involved. Therefore, we use the dividend growth model. On that basis, we get the enterprise value or the present value of your future cash flows, 377.59, 377.99. That's under Sajid's projection. Okay. Then the equity valuation. Equity valuation, as you know, when we get the enterprise value, actually the firm cash flows when you use, we get the firm value. Firm value. From firm value to equity value calculation is firm value includes equity value plus the debt value. So how do I arrive at the equity value? From the firm value, you minus the total debt. That is 149 million. So from the firm value, when you minus the debt value, you get the actually equity value. But please understand, there is a technical uh, calculation that is because of the cash and cash equivalent. Sometimes we can ignore this cash equivalent because if it is small amount, actually your valuation doesn't change or significantly change. So you can ignore the cash and cash equivalent. But as suggested answer mentioned, they say the firm value is the enterprise value. From there, they minus the debt value. Definitely, you have to do that to get the equity value. But they add the cash and cash equivalent because cash and cash equivalent generally is available within your company as of the balance sheet valuation date. And we don't take any income generation from the cash and cash flow in your free cash flow calculation. Therefore, we have to calculate your equity value by adding the cash and cash equivalent. But if it is very insignificant value, you can ignore that because the question doesn't talk about your enterprise valuation question. Actually, it is about the free cash flow simple valuation. So we can take the free cash flow based valuation 377 minus 149, which will be your equity value. You can ignore your cash and cash because it's a small amount. But if it is significant cash and cash you carry, then you can add on to your value and say that equity value includes now cash and cash equivalent also because it can generate future value also. Okay, so that's basically suggest projection based equity value. Then we go to the corporate finance projections. Same task, you are doing it again. Same task, you are doing it again. Here, you are talking about corporate finance projection where EBIT is 90 million. 80% of EBIT is your free cash flow. That is 72 million. So that's basically given in your table, working number 10. Then the income tax expenses, which is working number 11, the EBIT forecast they are given you, 30% of that, which is given there. So you can mention that 27 million is your tax for year 1 to 3. Then the terminal value calculation, which we are given, there is a growth of 5% like earlier, 5% growth, which is 75.6 million free cash flow. The tax is also 28.3435 based on working number 11. Yeah, there is a question about whether we have to consider the cash and cash equivalent. That's why I said cash and cash equivalent you need to consider if you are. So video is stuck. Can you all hear me? Yes. Okay. So the cash and cash equivalent you need to take provided if the question is talking about enterprise value and the equity value. But if you just take the free cash flow based valuation for the firm cash flow, what you are getting is the firm value, that is equity plus debt. From that, you minus the debt value, then you are getting actually the equity value. But if you have larger cash and cash equivalent value, that cash and cash equivalent also can generate some free cash flows in the future. So actually speaking, the equity value can be added with your cash and cash equivalents, so that your cash and cash equivalents will be added to arrive at the equity value, because equity value will be more than just the firm value minus debt value. That's a difference between your equity value and the enterprise value calculation. So if it is small cash and cash, you can just ignore. It doesn't make a difference in your total valuation. Okay. Then going into the your discounting factor for the corporate finance projection, it is your 21.7% for the year 4 onwards, or 22% for year 4 onwards, your discounting rate. First, first 3 years, it is 21%. Years, it is 31%, 31 for the working number 10. First, cost of capital is differing from fourth year onwards. So I believe that I don't think any confusion could be there. Again, you calculate your equity value from the firm value minus your debt value and add your cash and cash equivalent. So both gives us two values, right? Then we come to this probability calculation under working number 2. Working number 2. Can you all look at the working number 2? So working number 2 it basically shows you 231.79, which has a probability of 25%. Corporate finance team projection working 13, which we calculated 58.49, 75% projection, 75% probability. So when you add the expected value concept, when you calculate, it is under 1.82. So that's basically your value of the company, value of the equity under 1.82. Whereas our net asset based valuation, working number 3, you can see that comparison between the net asset basis valuation 229 million, free cash flow based valuation another 1 million, cash offer 175 million. Now, generally, what should be more? Right, more than answer, I just want to take the theoretical knowledge to make sure that you are clear. Which basis of valuation should give you higher value? Is it the net asset basis or free cash flow? Yeah, immediately your answer is free cash flow. I am with you. Free cash flow should give you the higher value, because that's the comprehensive method of valuation, which considers all the strategies, all the usage of resources, everything. But if your free cash flow based valuation is giving a lower value than net asset based valuation, what would be the reasons? Can anyone think what could be the reasons why your net asset based valuation is giving a lower value or higher value than the free cash flow based valuation? Quickly. Why? What could be a reason? Asset backing? Yeah, that means you actually, it's not about positive thing. It's a negative thing. What's a negative? You have assets, you have assets which are not earning sufficient return. Please make sure that you understand that point. If your net asset basis gives you higher value than the free cash flow based valuation, we should be aware our assets in the company is not generating sufficient profit. So we are not that profit, business is not profitable. Our assets, some of the assets, sometimes you might have a large building. Say, assume that you are having a one floor in one golf face, or one floor in a port city, one building. Assume that you have invested heavily, but maybe you are not generating sufficient profit. So your free cash flows based valuation will give you a lower value than your net asset based valuation. It's not about higher WACC. Higher WACC, one reason you can think. But actually, WACC, higher WACC is only at the beginning. Second phase of your WACC is lower. That is reflecting your real market condition. First 3 years only you have a higher WACC. So more than that, sometimes your assets what you have is not generating profit. Actually, are you making good profits in this company? Past pattern, past pattern of this company, they are not profitable. Last year, I think they have said last year the company has a profit or loss making. Last year profit or loss making. So it is unfavorable things in macroeconomic factor. I know, that's what I'm trying to tell you. If you are last year it was a loss making business, what my point is that your assets in your company is not generating sufficient profit. Could be reasons are, you can say macroeconomic picture, your bank borrowing cost is higher. There are many reasons. But what we have to understand, your asset, even though you have good assets in your company, which is not sufficient return making. They are not making sufficient return. Therefore, CSO loss of 12 million. Exactly. That's what my point is. Your assets have not been generating sufficient return. Therefore, your free cash to base valuation will not give you higher value than net assets. In other words, you are having good net assets, but you are not generating enough profits on that. You can see your property plant equipment is 403 million. Property plant equipment is 403 million. Maybe your property plant equipment is not well utilized. Maybe one of the reasons is macroeconomic factors are not good. No tourism was there, or people are reluctant to travel to Sri Lanka. There could be various reasons, and your cost of operation is very high. Your GP margins are lower. All that could be reasons. But my point, what you have to address here, or understand here, you are not generating sufficient profit from your assets. Therefore, I am not addressing this question answer. I am giving the knowledge for you to understand it when in your pre-scene or your question paper in the exam December could think about or give a information your net assets could be higher than your free cash flow. So don't be understand that your net assets are higher mean it's good. No, you are having net assets, but you are not generating sufficient profit. So your business model needs to be re-looked at to turn around the company. That is one of the reasons this company wants to sell this company. Understand that. Okay. So now we come to the comparison of your net asset basis value at 229, free cash flow base value 101 million, cash offer 175 million. Now what is your conclusion? Will you sell it for 175 million, or will you, because 175 million cash offer is very much more than your cash free cash flows, but it's less than your net assets. So what could be your answer? Can't we think about revaluation? That means we are going to do the revaluation or what? Because they are given you property plant equipment in your balance sheet. They don't talk about much about your whether revaluation is included or not, right? So you can revalue and look at it. That's all. I think more of a fair value point of view. If you are not given fair value, but already the book value is very much higher. That's what we understand. So I believe that they have revalued and brought the values. It is the nature of the industry is such that if there was a issue with your occupancy or the tourism, and we all know like last 3 years the country was on a very bad situation. No tourism was there enough. So definitely you will have a negative operational results compared to your balance sheet. Balance sheet could be better. It's like your assets are there, but you are not generating enough return. So what we have to point out here that offer price 175 million, free cash to 101 million, net asset 229 million. Now, should you sell it at 175? Is it attractive? That's a question. Can you give your comments? Is it attractive or not attractive? Anyone? What do you think? Is it attractive or not attractive? Anyone? It should be more than 229, need not accept the offer. Yeah, that is on the principle that your net assets are very much higher than your free cash flow based valuation and you are waiting. Now the question is, okay, true, 229 million is net assets value. If there is no offer in the market, more than 175 million, what do you do then? If anyone thinks that 225 million is net asset value, so we should not sell it beyond that, that's good. But there is no one in the market who could offer more than 225. Then what happens? Are you going to wait? So it's a question about whether you have realizable value or not. So free cash flow based valuation is purely what the cash flow you are going to generate. Net assets of the company are undervalued. Undervalued or overvalued? Net assets of the company are undervalued or overvalued? Yeah. Can we sell the assets in open market and get 225 million, which is over cash offer? Yeah, I am with you. If you are able to realize the 220, as I said, 225 million, if you can get from the market, then no problem. Don't sell it for 175 million. So you need to look at the market opportunity and see whether 225 million is there any offer. Even if you say as a hotel business you can't sell, but at least you can sell the hotel property, whether you can sell it. Because generally hotel industry, the hotel property has more value, right? Because it's a larger property, but only thing is tailor-made hotel. So you have to see whether you are getting offer. If you are getting offer more than 20 to 25, don't sell for 175. But at the same time, you have to consider whether you need cash, whether you are interested in running the business, whether you believe that you can turn around this company. If you don't have that confidence, might as well you sell it for 175 because which is very much higher than the free cash flow. Because based on your knowledge, you can only sell it at 175. Or you can have value for another 1 million, not 175, another 1 million is your value. So you need to ask question whether I can uh, run this company and the value would be 101. Should I sell it or keep it? So it looks the net assets are overvalued, or maybe the nature of the industry at the moment is not valuable at the moment. So if you can hold on to the business for a couple of years, maybe you can sell it more than 300 million. We don't know. That is the judgment or decision the owner has to take. So the answer here, I won't answer saying that sell it for 175. I will say if you can find buyer more than 225, ideally you can sell it. Provided you have time to wait for that offer to be received. If there is no offer for another 1 or 2 years, do we have the confidence to run this company at a profitable level for next 2 years? If you know, better you sell it for 175 because it is the good value compared to your ability. If you go for the offer, only get 170. That's what I was telling. You don't sell it for 175, provided you don't get any other offer. Right? You don't sell it for 175. If you are able to sell this hotel piecemeal, that is a building separately, furniture separately, everything separately, and you can get 225 million profit, then definitely you can sell it for 175. Before 2009, what was anything to share? Anyone? Before 2009, students can hear? Yes. Before 2009, what happened? Sri Lanka. War, exactly. Very good. So you all know that before 2009, we had Sri Lanka had a war. So in that case, so we know that before 2009, we had war. At that time, if you have a hotel in Sri Lanka, that is property has value. But cash flow, profits, very low. So if you are going to use the cash flow based or profit based valuation, you will have a lower value. Lower value. But net assets very high. Now the question is, I'm just taking you all to 2009 or 2008. Right? At that time, if you look at the net assets of the company, huge net assets, including five-star in Colombo. But profitability and cash flow, very, very little, very little. So if you value based on free cash flow or earning based valuation, you get a lower value. Now the question is, should you sell it or keep it? What is your answer? Can anyone say that? Anyone say that whether we should keep it or can anyone say that? See the market value. Yeah, what is market value mean what? Now you have property, right? A good hotel. Keep it for speculative. If there is no more offer at higher price, we yeah. If there is no more, actually, what happened during that period? If you are really want to wait for some time, longer period, till the war to end, because nobody knows at 2008 whether the war will be over in 2009. So if you don't know that, you know definitely net asset value is more than free cash. So what do you do then? So if you have requirement for your money, and if you don't have confidence about the future of the hotel industry, then you sell it. For what price? The price that is available for you, not your balance sheet. Just because your net asset basis of valuation 229 million, if there is no one to buy at 229 million, what's the meaning of that? If there is no urgency, exactly, if there is no urgency for cash, right, and you are confident in the industry also, if you have it, then hold on to it. If you can have the power capacity to hold on, you wait. If that is the possibility, then you will sell it at a higher price. 2010, 2008, you would have valued at 175 million attractive offer, but 229 net assets. 2010, 2 years later, war ended, for example, somebody would come and say, give him 400 million, not 229, 400 million. Why? Some full 365, 360 degree change you would see in 2 years. So people are going for hotel industry. So that is what you need to understand. Do not just memorizing net asset basis is more or free cash flow more. It's the circumstances in which we are operating. So please have that knowledge, not the number related or one is better than other. We all have to know knowledgeably which valuation method should give higher value. Exactly. So as far as you are understanding that, so your net asset giving more mean that is because of the circumstances. So, as an auditing professional person, you might think that it could be overvalued and you need impairment. That's the auditing side. But financial management point of view, I would say I gave you a very good practical scenario. We had it in 2008 and 2010. Same five-star hotel, same down south hotel, hill country hotels, where net assets were very much higher than the free cash flow based valuation. So, if anyone was in a hurry to sell it, you can sell it at 175 or 100 million or whatever. But if you don't want to sell it, you hold on to it. Even during COVID, I know there are certain hotel industry groups, not Sri Lanka, foreign. They went and bought hotel industry, hotel companies world over at a very cheap price. Why? 2009 or to the 2020, when the COVID came, 1 year, first year, people thought, okay, this is the end of it. No tourism, no future, no travel, nothing. So people who were worried about it, very not confident, basically sold off the hotels. So there were people or the owners or or people who had money went and bought hotels. Why? They know that one time the hotel industry will boom. So they bought it at cheap price, very cheap. That 175 million is the example here. This is a cheap price you're offering. You buy the hotel. But you know, 2 years down the road, tourism is back. Now entire world is traveling, right? Now 175 million hotel, you can sell it for 500 million. So please understand this concept properly, valuation concept, right? Actually, the scenario will make your valuation differ. Same valuation you did it 2 years back, 2020. If I had asked to do the valuation during COVID, I would have been very negative. Why no tourism industry future? We have said value is not there. But today, it's the other way. We are saying tourists are coming and we have now target, all that we are working on. So please keep that in mind when you are answering this part. So don't sell it unless you are hurry for cash and you are not confident in this industry. Then sell it for 175 million. Otherwise, hold on to it. That's the answer. B part. The B part, Yeah, can I read the question? B part. They are talking about RTL and GBT plan to go ahead with the merger process by issuing fresh RTL shares in exchange for GPT shares. However, decision has not been made by the parties on the share exchange ratio to be applied. RTL Director Board estimates that 10% gain on the pre-merger reasonable market price, that is 3.16 Maldivian rupiah, merger question. Now you can see the last 23 marks and 20 marks. 43 marks in one area basically. Your last paper, 23 June paper, basically first A part 23, second part 20, 43 marks. On what area? What chapter? Exactly. It's valuation. If you are very thorough with your valuation, merger and acquisition is an extension of the valuation chapter, right? In the sense, like your merger acquisition also uses again the valuation knowledge to value the companies. Okay, there are two company merging, but then again value the company. Then only you exchange your ratios and all that. So 43 marks out of your 100 marks is basically coming from the one chapter. So I always keep on saying that if you want to get through financial management, understand that valuation chapter is the fundamental, your foundation of your FM. If you are thorough with it, you are definitely getting through. Don't worry about it. So you need to make sure each and every piece of the valuation area you are very much clear. You don't have any doubts. That's why I spent time to explain this hotel related thing. Otherwise, you know how to calculate net assets, how to free cash flow. But what is the answer? You need to look at the overall valuation knowledge concept and apply that. Okay. So now when you go to the merger question, now we go to the merger question. They are talking about RTL. It's about a company board meeting after progress, privately owned company, given below business restructuring plan. Next few years remain flat. The earnings. Company needs to strategize to increase its earnings. And brief study revealed that inbound tours is a key business segment for hotels. So they are talking about they merging with a company called GBT. So the number of shares of both companies are given 1.25 million and GBT 4 million shares. Current earning attributable to equity holders, RTL has 2 million shares, GBT has 1.5 million, sorry, not shares, earnings, current earnings. Accordingly, already they have done a valuation. Accordingly, valuation firm has valued both companies value Maldivian rupiah 16 per share and 3.16 per share. Both companies value are given per share. And total number of shares are given. Both RTL and GPT agreed to consider these values as a reasonable market price per share. So already they have accepted this is the reasonable price. Then the business restructuring plan. So they are going to merge with these companies. The two companies are going to manage merger, right? And they have given you enough information. Starting with a local party, since there is a seafood processing facility that's not making money for GBT, they want to sell it. They want to sell it. So they will get 1.83 million if they sell the GBT sell the seafood facility immediately, 1.83 million. But the seafood facility presently contributes 0.2669 million Maldivian rupiah. That is the income they are generating already. So when you sell it, what's going to happen? You don't get that income. And they already mentioned that 0.2669 million is included in your current earnings of GBT, which is 1.57 million. Then common use of assets and resource pool would allow GBT to increase its earnings by 25%. So basically common use of assets, resource pool, that is after merger, you are able to increase the earning. You are able to increase earning by 25% on permanent basis. And some other assets which they feel it's excess, they will sell it for 2.6 million. Then the whole merger process. Definitely, when you are going to do a merger, you have to incur some cost. That merger cost will be 800,000. That will be incurred by RTL. Then they talk about assume that P ratio, whatever we have at the moment, will not change. Will not change. Then the directors at the moment considering one RTL share for every 6 shares held by GBT, but this will be subject to detailed analysis. So that's basically your B part information available. So we know that it's about a merger related question. And what is the question they're asking? Advise RTL directors on a share exchange ratio that would maximize the exchange shareholders' benefit while deriving 10% gain for GPT shareholders. So the question is only one line or maybe just one sentence to say that calculate the exchange ratio, which will basically give the GBT shareholders 10% gain. That's basically the question. But already they have given you exchange ratio. What is the exchange ratio? Can anyone say that? Already have they given the exchange ratio? Exactly. One RTL share for 6 shares of GBT. Already they are given. So that is their proposal. That is their proposal. But this will be subject to detailed analysis. So the question is asking us what is the exchange ratio we should give so that GBT shareholders value will increase by 10%. Okay, so that's basically a question. So in order to do that, firstly we have to find out what's going to be the earnings of these companies. Okay, so can you take page number 15? Can you look at page number 15? We take slowly. Page number 15. Firstly, the information is given how many shares each company has. 1.250 or the 1.2 million, 1,250,000. GBT has 4 million shares. Reasonable market price, which is already given. That is all given by the question. 16 rupees, 3.16. Earning attributable, that is all given. 2 million and 1.57 million. Now, when you look at the GPT value, existing market value, you can multiply your market price 3.16 by 4 million shares. That gives you 12.6 million. So existing market value, the that is they have mentioned that 3.16 and 16 rupees are the fair value of the shares. So when you multiply the 4 million shares by 3.16, you get 12.6 million. So that is your market capitalization or the value of the GBT. And we are given the earnings of the company, that is 1.57 million. So presently, before the merger, please understand that, before the merger, GBT company on its own valued at 12.6 million or 64 million. Earnings are 1.57 million. So what is your P ratio? You can divide your, what do you do? Anyone? How do you calculate P ratio? Market value divided by earning per share, that is per share calculation. If you are talking about total, market value per share divided by earning per share give you P ratio. If you are talking about total profits and total market value, then market value divided by profit after tax. Exactly. Profit after tax into earning per share? No. Please understand, your P ratio equation is PE ratio is equals to market price divided by earning per share. Market price divided by earning per share. Same P ratio can be calculated comparing the total value, not the per share. Because P ratio, when you calculate market price divided by earning per share, one share you can take the market price, one share earning per share. Otherwise, total profit after tax divided by total market value divided by total profit after tax. It's a number of shares multiplied. Both you multiply number of shares, you get a total market value divided by total earnings or profit after tax. Okay, so in that case, P ratio is calculated. P ratio is calculated. So that is 8.05. Presently, GBT is valued based on earnings 8.05 times. Then existing earnings of the company, GBT, 1.57 million. And we will lose the seafood business we are going to sell. When you sell it, we will lose the annual income of 266,900. So you minus that. So that is not a sustainable income year after. Sustainable income year after because you are going to sell the seafood business. Then you get the net earnings 1.3 million. That will go up by 5%. That means your 1.3 million become 1.6 million. So now please understand your new earnings of the new earnings of GBT will be 1.6 million. So when you multiply 1.6 million by 8 times, the earlier P ratio, because they give you understanding, P ratio will not change. So theoretical new capitalization will be 13.1 million. 13.1 million. Apart from that, you are going to sell the seafood. That's a one-off cash flow you are going to get. Your 13.1 is your market value based on your future earnings. But you get 1.8 million now. So that is also you will get your total value because that's your cash now. So that is why we are adding the 1.8 million to get your total value at the moment. That is 14.9, almost 15 million. So 15 million is your GBT value based on the future earnings. Then RTL. RTL existing, we have 2 million shares, sorry, 1.25 million shares and 16 rupees market value per share. That multiplication will give you 20 million value. So your present market capitalization is 1.25 million shares into 16 rupees per share. That gives you 20 million. Again, that 20 million is based on your present value. That is without your sale of assets. The sale of assets will give you extra cash. You that is also will add your value, 2.6 million. Because immediately you will sell it, you get that cash. So that cash also your value, 2.6 million. Then the merger related cost, 800,000 we have to incur. So we are going to incur 800,000 rupees, the Maldivian rupiah. Then we get 21.8 million. 21.8 million. So what is your RTL value? 21.8 million after the adjustments and GBT value 14.9 million. When you combine these two company value after the merger, 36.744 million. So are you all clear? Any question on that? Any question on your merger total value? From your understanding, is there anything you confused? Please understand, based on your future earnings or future cash flow, your value is calculated. Apart from that, immediately you are selling some assets that gives you some value because that assets were not giving any cash flow in the future or they were not operating any income. So basically we get the understanding now. Your total value will include your future earnings or cash flow based value or the fair value plus your disposal proceeds, which is also adding to your present value. That's why we have got 36.744 million. This is the combined value of the both company. This two company merger, does it generate synergy? Question doesn't talk about it. Does this merger generate synergy? Anyone? How much? Before the merger, what is GBT value? Before the merger, when you say merger, there is two times. Before merger, after merger. Before merger, those two companies are not connected. Two different companies. What was the before merger value? GBT. It takes step by step. This question didn't talk about market value. This question talk about the how much is the RTL and GPT share value per share? I read it also earlier. Business valuation firm has valued RTL and GPT shares at how much? Can you hear me, students? Yes. What is RBT, RTL and GBT share price? I think in the unseen question paper, exactly 16 and 3.16. So that is the price per share they are valued. That's a valuation firm valued the RTL and JPT shares as 16 and 3.16. Based on that valuation, tell me before the merger, this is before the merger. Before the merger, RTL value is how much? We'll take step by step. What is RTL value before the merger? 20 million. GBT 12.64. So what is the total value? 32.64. So 32.64 million is the total value of the two companies before the merger. Total value of the combined entity after the merger, how much? Exactly. After the merger, that's what we calculated based on the earning change, disposal impact, all that we considered. We got 36 point something. So what is the synergy? The difference between combined entity value after the merger and the merge before merger two companies value. So that is 32 point something and 36 point something. What is the difference? 4 point something is your synergy. So this is not asked by the question, but you all should have understood, even though it was not asked, it is the synergy of the combined merger or the merger. Okay, so that's for information. It's not question by the examiner, but please understand there is a synergy in this merger. 4 million synergy. Why it's important? You need to understand what is RTL directors. RTL directors wanted GBT shareholders value to go by how much? That's a question. 20 marks question. Can you read, please? The B part, 20 marks question. Can you read that paragraph? Very good. Everyone has read it. 10%. So they are requesting, they are looking at the 25%. What is 25%? I don't know from where you got 25%. B part of the question. Can you read the paragraph? Please read it. B part of the question. Somebody who got 25%, can you read that paragraph and make sure that you understand what is the GBT shareholders value to increase expected. Now RTL and GBT is merging. Exactly. 10% gain. 10% gain on the market value of the REM. So if you are talking about 10% gain, if you are as a one of the share, one, two out of two company, one company RTL, other one is GBT. RTL directors wanted GBT shareholders to benefit by merger 10%. In that case, your merger should result in synergy or should not result in synergy? Should. Definitely should. And what is the synergy percentage? What is the synergy? No, no, no. Need at least 10% is all requirement. First of all, understand before the merger, what was the value of these two companies on their own? When you add these two company value on their own, when you are running, they had two values, 20 million and 12 point something. What was the total value of two companies? Just add it, 32.64 million. After merger, how much the value? Very good. Somebody found it. 36.74 is the after merger combined entity value. That combined entity value includes synergy or not? Combined entity value includes synergy. Now tell me, before merger, two company value, after merger, two company value, and you know there is a synergy. What is the synergy percentage? Exactly. Somewhere around 12.5. So 12.5 percentage is the overall synergy. Now tell me, 12.5 synergy, who should get? Who should get the 12.5% synergy? Or synergy belongs to whom? Very good. It belongs to shareholders of both companies. Shareholders of both companies, RTL and GBT. Both shareholders should get the synergy benefit. So in that case, 12.5 is the overall synergy benefit. Now, RTL directors wanted GBT shareholders to get what synergy percentage? Exactly, 10%. So out of 12.5 percentage, you are going to exactly GBT shareholders to get 10%. RTL shareholders will get how much? 2.57. Come on. You all are missing the whole thing. How much your total value of the combined entity after merger? How much is your combined entity after merger value? 36.74. 36.74 will be shared among the both shareholders, both company shareholders. Okay. So before the merger, both shareholder value total was how much? 32 point something. So entire 32.64 million value, does it have a benefit of 10, more than 10%? Entire 32 point value Does it have a benefit of the synergy benefit of the more than 10%? Yes, definitely yes. So if you break into two parties, there are two parties, both will have to get more than 10%. But one party, we are going to give only 10%. Then other party will get how much? 90%. No. You all are confused with your basic numbers. Now, 2.5. No, you are talking about 32 million, right? 32 point something is your total value. And that is becoming 36 million. So 36 million you are going to share. Now take the two parties equal share 50-50. Each party has 50-50 combined value earlier 50-50. How much then 32 is? So we have A and B. A and B. Can you see? Can you see the screen? Yes. 32 million. You have a value 32 million, say 16 each. Okay. This is before the merger. Before. Value after, we are talking about 38 million, for example. Then if you are going to take equal share, 19 each. 19 each. What is a percentage increase? Can you calculate roughly? We say 1880. This is for understanding, huh? Not your number, exact number. How much? 16 to 18? 12.5. Exactly. Is it 12.5? Anybody? Double check the number. Yeah, 12.5 both. So if you are going to give equal, both will get 12.5 gain. Are you clear on that? Are you clear first? Yes, right? 12.5 both will get. Now, we are saying one party, B, we are going to give 10%. How much 10? If you are going to give only 10% gain to the merger benefit is there for both. But you are going to give only 10%, which is how much? 17.6. 17.6. What is your total combined value? Total value earlier 32. After merger, how much is the total combined value? 38. We took 30, 36, right? 36. Right? So if it is 17.6 here, how much is here? Total 36. You are only giving 10% to B. That is 17.6. Then other party, how much you are going to get? 18.4. 18.4. 18.4 to 16 on the percentage. How much? Exactly. So those who answered earlier that you get out of 12.5 when you give 10% to other party, how much your balance is? 2.5. I don't know who told you your maths. Please understand, both parties are entitled for the synergy benefit of 12.5. Out of 12.5, one party we are going to give 10. Just because we give 10 doesn't mean that 2.5 only other party gets. No. Both parties entitled from 32 to 36. Right? You all have 12.5. So both parties entitled 12.5. But only one party we are agreeing to give how much? 10. Then who is going to get the balance? A party. A party gets how much? 15. So please understand, in synergy, if you are going to give one party lesser benefit, The other party get a larger sunk of the benefit. Okay. So if you take RTL and GBT out of this merger, who is more powerful? Or who is stronger? Exactly. RTL is the stronger company than the GBT. So when you are, it's like a normal any business transaction, right? The company which has more strength or more capacity, more power, all that will be able to negotiate for themselves better. So even though synergy benefit give you 12.5 gain, GBT will get what gain? 10% or 15%. GBT, we would like to give more gain or less gain. Exactly. So GBT, you give less gain, then you will get more than GBT or you less than GBT. Yeah. So I think this area, the examiner are not tested on this question, but you have to be aware of this thing. The synergy, how it get distributed is what I explained now. Okay. So now we come to the question. So we have been talking about your synergy benefit 37.4 million, right? So we come to that calculational part. So basically, we are first going to take the 1:6 share issue. So we will go and give the 1 share for 6 shares held. So what is the number of shares we are issue? Which share we are going to issue first place? Can we get the answer? Which shares we are going to issue? RTL is going to issue shares or GBT? I think in the question, unseen material, Roman number 6. Can you read the Roman number 6? Following details are available. Exactly. RTL is going to issue the shares. So after merger, which company will disappear? After merger, which company will disappear? Exactly. GBT will not appear. So even the GBT shareholders will have which company shares? RTL. So after merger, only one company exists. That company name is RTL. So please be aware of those things. Very basics. RTL is the merged entity name. GBT will not appear. So GBT shareholder who are present shareholder of 4 million shares will be getting RTL shares instead of GBT shares. So GBT shares get cancelled. You get to cancel the 4 million GBT shares and get the RTL shares. So how many RTL shares will be issued? If you are going to go on a one RTL share for every 6 shares of GBT, how many RTL shares we have to issue to GBT shareholders? How many? Exactly. 666,000 RTL shares. Already how many RTL shares we have? How many shares we have already in RTL? 4 million. 4 million GBT. RTL shares 1.25. So 1.25 million, that's the basically the answer, suggested answer says your new share issue according to the share exchange ratio, what is given in the question, new share issue 666,000 something, existing share 1,250,000, total number of shares 1.9 million, right? So total number of the merged entity will be 1.9 million shares. What is the total value of the merged entity? What is the total value of the merged entity? 36 million. Is it 36 million? Yeah, 36,744. So that is your combined entity value. So combined entity value 36.74 and number of shares of the merged entity 1,916,000. Now we can calculate what is the per share value after the merger. So you can see the theoretical RTL share price, that is after merger, 19.17. That is 37 million divided by 1.9 million. 1.9 million when you divide 37 million, value of the combined entity 19.17. Now 19.17, please understand, right? 19.17 is the RTL one share value after the merger. Now tell me, what is the GBT one shareholder value? GBT earlier shareholders, if he has 6 shares, today he has how many RTL shares? 1 share. Exactly. So if I say 1 share of RTL price is 19 rupees something today, what is the earlier GBT 1 share value? Where he got so many shares? They get 6 shares, right? So in that case, 3.20, it's the market price per share. If you say RTO share 19.17 divided by 6, that is 3.2. So 3.2 is the market price of GBT share after the merger. There is no GBT share, but earlier GBT 1 share when you are owning, that share price is how much? Before the merger, if you are a 1 share hold of GBT, what was the share price earlier? Exactly, 3.16. Now after merger, you have RTL share, 1 share, but RTL 1 share equals to 6 GBT share. So in that same understanding, if the RTL 1 share is 19 rupees something, that is equivalent to earlier 6 shares of GBT. So 1 GBT share is worth how much today? 117. Please understand, 1 RTL share equals to 6 earlier GBT shares. So if it's a 1 share of RTL is 19, your GBT share is 1/6 of that, which is how much? 3.20. And before the merger, your GBT share was 3.16. So how much again? How much again? 3.16 to 3.20. How much again? Yeah, 1% gain. Only 0.04. I don't know from where you get these numbers. 3.20 divided by 3.16. How much? 3.20 divided by 3.16 is 1%. So it's only 1% gain. How much expectation of the directors? How much is the expectation of directors? 10%. So are you achieving the expectation? No, no. So that is the question. Now, actually, the as per the share exchange offer what they given, you will be able to give only 1% gain to the GBT shareholder. But that's not the objective of the RTL directors. So if you read the answer, in order to give 10% gain, this share exchange ratio will not facilitate. So what do I do? We need to now calculate the exchange rate ratio which will give 10% gain. Which will give 10% gain. So you have to first find out what would be the GBT share price. What would be a GBT share price we should get, target price, so that the 10% gain can be there. 10% gain can be there. How do I calculate? Just understand that your target is 10%. Your, your target is not 1%. The GBT shareholder should gain 10%. So if you want to give GBT shareholder 10% gain, the 3.16 share price before the merger should go up to what price? Exactly, 3.48 price. So your target is 3.48. So you need to understand that 3.48 should be the price. Now your 3.48 should be your target price. You should achieve 3.48 share price so that you get the 10% increase to the GBT shareholders. So in order to get this, what should be your share exchange? What should be your share exchange? So you need to understand your total value. Total value is 36.7 million share value. That is the combined entity value, 36.744. 36.74 is your, like what I explained earlier example, your total value of the combined entity 36.744. How much is GBT shareholder value before the merger? GBT shareholder value before the merger, how much? Before merger, the GBT shareholder value is how much? 1.16. That is per share. What is the total value? Exactly. 12.6. After merger, after the merger, GBT shareholder value is how much? How much we wanted them to expect, what we wanted them to get. After merger, GBT shareholder value should be how much? What is the target? Before the merger, 12.64. After merger, their value should go up to how much? 10% more than what they had. How much is that then? 12.64 is the present value. That will go up to what value? 13.9. Exactly. So what is the increase? What is the increase? 10%. So first understand your GBT shareholder wealth before the merger is 12.64. They should they should get after merger value 10% more than what he had earlier. That is going to be 13.9. After merger, what is the total combined value? Total combined entity value how much? 36.744. 36.744. The total value will be shared among two parties, RTL and GBT. How much GBT is going to get? 13.9. If out of 36.74, you are going to give 13.9 to GBT, then RTL value how much? Very good. 22.8. RTL will get 22.8. RTL will get 22.84. When you add the 22.84 with 13.9, it comes to 36.74. Right? So you need to understand that RTL RTL will be getting 22.84 value, which RTL shareholder will have 22.84 and 13.9 will be for GVT shareholder wealth. Both together only 36.7. What was the RTL value before the merger? Exactly 20 million. So RTL before merger value 20 million. So what is the increase for them? How much? 14 point. Okay. So please understand that the early example I showed you, out of 12.5, if you give one party 10%, other party gets how much? Out of total merger value creation synergy 12.5, you give one party 10%, other party gets more than 10%. Am I right? Same point here. Out of total growth, you said 12 point something, you give only 10% to them, then other party gets 14.2. 14.2. So that is your combined entity, how the value 36.74 shared among these two parties, provided you get 10% for them. 10% for GBT, balance goes to other party. So this is how you are going to target. So now look at your suggested answer, right? So accordingly, your 3.48 target price to be achieved, right? You will see that your value, your value will be new theoretical right price will be 18.26. That is 14% we talked about, right? So accordingly, your share exchange ratio will be 21 shares to 4 RTL shares. 4 RTL shares. That is in order to match your value. What is the ratio you are going to have, right? So after that share issue, you will be having the 14 percentage growth in the RTL share price, and the target price you will achieve because that will give you a 10% growth. So that's basically your answer for B part. So please understand this total value, how it's split into GBT, your 10% target. So your 12.64 become 13.9. Then 10% become 14% for these people because you are giving lower gain, even though the merger benefit us by 12.5% merger synergy, only 10% we are giving to one party. Then automatically other party has to get more percentage in the value. So that's what we are getting. 20 million become 22.84 million. So accordingly, your share get exchanged, right? Then we move on to the third part. Third part. Can you read the third part? It's a 7 marks. Can you read that question? Evaluate the Forex and reinvestment strategy of both RTL and PTL, 7 marks. So it's about the, uh, what I would say, the foreign currency management area. About the two companies, they are talking about PTL and the RTL. So the question is about how the exchange risk management could be used, right? I'm not taking the suggested and word to word, but you need to understand in the concept point of view. I would like to explain the concept here properly. Firstly, any assets, if you are investing in foreign currency, how you should be financing? Any assets, if you are investing in foreign currency, how you should be financing? Anyone? If you are investing in, no, if you are investing in assets in foreign currency, how you should be financing? Borrowing. No, borrowing, yeah, borrowing you can finance, but my question is about foreign currency management. Exactly. Any currency, if you are investing, ideally, if you can, borrow in the same currency. Borrow in the same currency. That is basically the concept called matching assets and liability. Matching assets and liability, one of the risk management technique. So we need to be clear here. If you are going to talk about getting money from a party and then collect the money and convert into dollars and then repay the party on the other side, you need to make sure that if I am going to keep my payable in dollars, I should keep my assets also in what currency? If I'm going to have the payable in foreign currency, my receivable also should be in foreign currency. If I don't have receivable in foreign currency, that's in rupees, and my payable are on foreign currency, I will be in trouble. It's like I'm a rupee, I'm a businessman who are having a rupee business. That means I don't get involved in a foreign transaction. But I got an opportunity to borrow money in dollars. So my business, I go and borrow money in dollars. And we don't have dollars. We don't earn dollars. Then what's the problem? If the rupee, Sri Lanka rupee depreciate against dollar, you are in trouble. Why? Always your liability will go up continuously. Why your dollar liability will go up? Your liability in dollar form and your receipts or collections or earnings are in rupees. So always you have to put extra pressure to earn more money to pay your dollar liability. This is the same thing applies to our country. Because most of the borrowings are in what currency? As a country, we have liability, right? We all have 1.2 million worth rupee loan for each and every person in citizen of this country. 1.2 million rupees. But when you multiply 22 million, you can understand how much amount of loans we have taken. The government has taken, but we are responsible, right? We are responsible. We also have in our aid. So always remember that your payable, if you're having in payable or loan or anything in foreign currency, you should have receipts in the same currency. Otherwise, you are going to be in trouble because anytime your rupee is depreciating, you have to pay more rupees to pay the dollar liability. So that's one important thing in the whole discussion. Actually, if you look at suggested answer, they will explain the same thing. But I'm trying to put it in a nutshell is asset liability matching as one condition you have to maintain in foreign currency management. Second, if you are going to invest, you have investment opportunity. For example, treasury bills. Sri Lanka treasury bills are giving say 14%. Maybe US treasury bill give you 5%. Now, when you are going to compare US 5% and the Sri Lanka 14%, it looks which is which is attractive, which is attractive. 14%. Sri Lanka is attractive. So if that is the case, why the other countries in the world are investing in their country rather than investing in Sri Lanka? If you and me understand that Sri Lanka, if they invest, they get 14%, why they are investing in US bonds and US investments? Because there is no risk involved in the area. Rate. Yeah, true. There is a risk involved. But more than risk involved, if you have learned foreign currency risk management, understand you cannot compare your rupee interest rate with dollar interest rate. Why? There is a exchange rate impact. Exchange rate impact. Even though a US citizen, assume that US citizen, he puts his $1 million in Sri Lanka investment treasury bill. So he convert the dollars to Sri Lanka. In Sri Lanka treasury bill, he invest. And how much he gets? How much he gets? US investor, say $100,000. $100,000. He invests in Sri Lanka. In Sri Lanka, in US. Sri Lanka, we say 330 rupees. How much Sri Lanka rupee invest in government securities? $100,000 he invests in Sri Lanka treasury bill. He convert into rupees and invest. How much Sri Lanka rupee invested? 33 million. And we say the interest is 18%. For example, 18%. How much for 1 year he gets? This is the investment. This is the interest. 18%. 33 million, 18%, how much? 5.9. End of the year. End of the year. How much you get? 38.9. If he has invested in US is a 6%. How much you get interest? 6,000. How much he gets end of the year? 106,000. Now tell me, investing in Sri Lanka, investing in US is beneficial. Investing in Sri Lanka, investing in US is beneficial to him. What is the effective exchange rate? Yeah, you don't know the year-end rate. I'm asking. Based on this value, if these investments have to be treated as equal, what would be the exchange rate which will make these two investment opportunity equal? Can you calculate that? How much? 367.35. 367.35. One year's time, if Sri Lanka rupee is more than 367 rupees, is it dollar investment is worth it or Sri Lanka rupee investment is worth it? Exactly. Dollar is worth. Dollar is worth. Why? When you convert the 38.94 million by 370, you get more dollars or less dollars? Less dollars. So you gain. He gets less dollars. So what is the answer? Whenever we are going to compare the foreign currency interest rate with the local currency interest rate, what should be looked at? when you are comparing dollar investment and rupee investment, or dollar borrowing and a rupee borrowing, what needs to be looked at? The exchange rate depreciation or appreciation. Not the dollar rate. Don't say dollar rates. Exchange rate depreciation or appreciation from today to 1 year time or 3 months time, 6 months time. So we need to look at that before saying Sri Lanka treasury bill rate is 18, dollar rate is 6%, Sri Lanka is attractive. Don't tell that. That's the wrong answer. Sri Lanka is not attractive. You need to look at what is exchange rate depreciation. If your depreciation is heavier, right, then converting to Sri Lanka rupee and investing is a uselessness. Like you lose money. You lose money. If the depreciation of the currency is not that higher, then it would be better to keep it in rupees. So the decision making of you putting the money where dollar or rupees will depend on not only the interest rate. Please understand, it is considering the dollar interest rate and rupee interest rate is one thing. Very important thing is the exchange rate depreciation or appreciation. So that's basically this question. The last part try to explain you. One is that matching assets and liability. The other one is that keeping the money in foreign currency or local, wherever the treasury bill or whatever investment, you need to be careful. Always remember it's not only the interest rate, but also the exchange rate depreciation or appreciation. This is a good example. Right? You can see that how much it's appreciating, how much depreciating. Depends on that, your decision will change. So if Sri Lanka, generally we have a track record of appreciating or depreciating. Very good. So we know that. So we have to be careful when we are looking at these options of evaluation. Always remember the exchange rate risk management area is for that. You have to consider that impact when you are looking at the option of investing in both currencies. Okay. So that's basically the last part. Okay. So I believe that we have gone through some answer, but more than answer, I wanted you all to know certain things conceptually. That's what I took the synergy related. Even the examiner has not asked that area. We gone through it for us to understand how the synergy is creating merger value, and then I think we will stop with that, right? So we'll be having most likely next week. I think the CA Sri Lanka will inform you the pre-scene, your pre-scene discussion, right? So I would like you to go through the pre-scene and analyze the case before we come into class or whatever we're lecturing. Most likely it will be next week. So go through that at least once or twice and make sure that you analyze the case enough, and then please join. Thank you.